All right. We are about to get started here. Give everyone a few seconds here to join. Appreciate you taking time to check out our lunchtime webinar. We like doing these sometimes in the evening, but a lot of times during the day. People have more time to sit back and uh, watch a webinar and take some notes, and hopefully help you get to where you want to go. My name is Greg Unthank. I'm the uh, head of the Greg Unthank team, eXp Realty. I've been a managing broker in the state of Ohio for quite some time. I'm also licensed in the state of Indiana. So, got licensed in 1988. I've been through the slow markets of the late 80s and early 90s, the quickly escalating markets of the mid and late 90s and early teens, the market crash in 2008 to 2012, kind of the steady market years after that, and then COVID and the explosion that we've had in the last few years. So we're entitling this webinar "How to Buy a Home in a Changing Market." And although markets are always changing, there's different strategies involved depending on what that change is. So the change that we're going in now is a shift from a fast escalating, very strong seller's market to more of a traditional buyer's market. But the caveat in there is that, and what it's costed is just the rise in interest rates. If you had told me in February that we would be looking at rates in the sevens by November when we were 2 3/4 back in February, I would have told you that you were out of your mind. But that's where we're at, and there is opportunity in all markets because I've been through them all, and there's certainly more than one way to skin a cat. So that's kind of what we're gonna talk about today. I am using some new software for the first time, so I might have to pivot here, but I think we'll be okay. So what we're going to be talking about specifically is number one, the best way to find and view homes in today's market. There's certainly been lots of changes over the years, and there's some ways that are better than others as far as actually looking at the inventory that's out there on the market. We'll also talk about how to reduce or even eliminate your down payment. Down payment tends to be an obstacle for a lot of first-time home buyers, especially. As mentioned, rates have risen. So how do we work within that to get your monthly payment lowered? And there's some strategies to do just that. Also, strategies to beat out other buyers still for the home that you're interested in. Depending on the part of town, it is still a strong seller's market. We're still seeing houses go into multiple offers, not at the rate that we did earlier in the year, but it is still happening again, depending a little bit on the price range and part of town that you're in. Just FYI, a lot of these strategies you can do on your own if that's something that you're interested in. However, if you do want some help, we are here to do that. That link that you see there to put a call on my schedule. I'll talk about that later, but you're certainly welcome to do that and to talk about anything in more detail that we're going to talk here today. And if you do choose to work with us on the buying side of things, there's no cost to that as far as commissions or money or anything like that coming out of your pocket to us. Just so you know, we're paid through the MLS real estate system, not out of your pocket at closing or anything like that. So getting started, most buyers do this whole process backwards, and by backwards, I mean they start looking at houses and looking at the inventory and don't give a lot of thought to the financing and that part of the process. And it's even more of an issue today because people just have access from all sorts of different online uh, uh, portals to get information about real estate. So it's easy and common to be clicking on listings, but not giving a lot of thought to the financial part of it and why that's important. So just to give you an example, I'm going to go through a couple of transactions. So let's say we're looking at a property. The price of the house is $250,000. It's a 4-bedroom, 3-bath home. It's in a popular part of town. The seller has had the house appraised. They also know of other area sales that support his price. So there's going to be a lot of competition for the home. And as an agent working with you, let's say we prepare the paperwork, or you've done it on your own, and you approach the seller and you say, Mr. Seller, I'm interested in your home. And let's say you are delivering a stack of $100 bills, one after another, totaling $250,000. As you might imagine, if as a homeowner myself, that would impress me if that was the offer. Looking at a second scenario here, let's say now we got the same house and the same price, same situation, same seller. This time, when we go to the seller, we say, my client is interested in your home. It's a lovely home. It's got a wooded view. It's exactly what they wanted. My buyer says they have steady employment. They tell me they've got good credit. Matter of fact, they're going to go to the bank next week and apply for a mortgage. And we should know something in about 45 days or so. And we'd like to offer $250,000 on your home. Well, you say, well, Greg, that makes sense. That doesn't sound like that's as exciting of a proposition for that seller. But the last time that we checked, we didn't have $250,000 laying around the apartment or in a bank account or anything like that. But we can kind of create the same impact by getting the right kind of home loan pre-approval set up front. And again, as somebody who's been on both sides of transactions, I can't tell you what an impact a well done pre-approval is on listing agents and on homeowners. And I say right pre-approval in that there's some pre-approvals you can jump online and get real fast, and yes, you're pre-approved. And then what happens is you put the house under contract, everything goes to the underwriter, and then they start picking it apart and wanting proof of this and letters of explanation about that. And that's what you don't want. You want a pre-approval where everything is finalized and in place. There's actually pre-approvals that we have where you truly are a cash buyer, even if you're going to get a mortgage. And I can talk about that, and we'll talk about that here in a little bit. But for most people, and for the most part, to be the strongest possible buyer on paper is to get all of that pre-approval work done up front. So step one in the process is to research those home loan programs and get the right pre-approval done. We can help you with that. There's plenty of information online. You can research to obtain that real pre-approval. But the benefit to you is once that's done, you're pretty much a cash buyer. The house has to appraise if you're getting a mortgage for what you're paying for it, but all the other stuff has been done for the most part, and you're ready to go, and that's going to impress that seller. So let's talk a little bit about real pre-approvals and what that means. So in addition to the lending entity that it comes from and who does the pre-approval and how important that is, we also want to give some thought to the strategy and what type of pre-approval makes most sense for you based on what your goals are and what you want to do. So in this changing market, the most immediate thing is the rise of interest rates, as mentioned earlier. And the higher interest rates mean a higher monthly payment, and higher payments, of course, have all kind of implications on how much property you can afford, and how your budget is going to work with rates being a little bit higher. So if you're concerned about that, there are some strategies to get those monthly payments lowered. And the most common is something called an interest rate buy down. And basically the way that works is there's a market interest rate, and there's a sum of money that's paid up front to lower that rate and lower your payments once you own the home. And the good thing about that is that usually that buy down can be paid for by the seller of the property, so you can kind of work it into to your negotiations. Now, buy downs come in a couple different flavors. One is temporary, one is permanent, and it kind of depends there on what you're looking at as far as how long am I going to be in this house. So in my opinion, if you're going to be in a property for 5 years or less, you probably want to look more towards a temporary buy down versus a permanent, which is more expensive, but worth it if you're going to be in the house, if it's for your forever home, and you're going to be there for the long term. So a way, or the way a buy down would work. So let's look at the temporary, since that's the most common. So we have a home that's being purchased for $300,000. We're going to do what's called a 2-1 buy down, which simply means that the interest rate in year one is going to be 2 points below the market rate, or what that fixed rate is going to be. Then in year two, it graduates up to 1 point below the market rate. And then in year three on, you've got your market rate. So what happens is in year one, obviously, you're 2 points below the market rate, so your payment's going to be cheaper. In this example here, your principal and interest part of your payment is going to be $392 less for the first year that you're there. And this usually makes more sense than doing like a 1-year adjustable mortgage or something like that, because unlike adjustables where things can kind of move over time and sometimes even get out of hand, a buy down program is all predetermined, so there's no surprises there. So a lot of times transitioning from an apartment to your first home, or you're still living with your folks, you're in your starter home and you're going into a more expensive um, dream home type property, that transition uh, can be a little steep, where this allows you to kind of gradually work into it and giving you a cheaper payment up front. And if should rates go down in the next year or two, which hopefully they will, you can refinance at a fixed rate with a more traditional 30-year mortgage. Another advantage to this is if you have some debt that's going to be coming due. You've got a car payment that you're going to be paying off this year, or credit cards that you're going to be knocking out, what have you. It gives you a chance to lower your mortgage payment while you take care of that. And then by the time that the payment raises up, you will have taken care of that other debt, and it's kind of a wash from a budget side of things. So that's one way to combat the monthly payment and the higher interest rates now. And as I said, we can talk about adjustables and things like that, but the buy downs are real popular. Another issue is down payment. A lot of first-time buyers don't have a lot of money to put down, and that can delay home ownership. So there's some ways to combat that in the market as well. We have lenders that will do actual, 100% loan to value, zero down payment loans. So you've got no down payment required up front. You do have closing costs. Those can be paid by yourself, or they can be paid by the seller as part of the negotiated transaction. On this particular program, there's also no private mortgage insurance, and that'll save you about $100 right there in monthly payments, because you don't have that mortgage insurance as part of your payment every single month. With this program, it's got to be your primary residence, can't be investment property or anything like that. As mentioned, the seller can contribute to the closing cost. Has to be a single family home or a condo. With all of these programs involving, whether it's no down payment, whether it's down payment assistance, you've got to have good basic credit, because it's a risk situation. The lender is taking on more risk by not requiring a down payment. So because you don't have, in this case, any skin in the game on the down payment, they're going to want a lot better credit score than what they would in more of a marginal situation. So good basic credit, or the ability and desire to raise up your credit standing is what you're going to need. There are income caps with this particular program, as there are with a lot of these types of programs. In this case, you need to be probably in about that $250,000 range or below to utilize it. The other next category, and probably what we do the most of, are the government insured loans. And these are like your FHA loans, your VA loans. A lot of people think with FHA, you have to be a first-time buyer, and you don't. Anybody can get an FHA loan. You just can't have two of them at the exact same time. But compared to a conventional type mortgage, FHA does allow you to have rougher credit. Though we've got lenders that'll go down to a 580 on the credit score. There's some other qualifying factors that come into play there in the way of maybe reserves in the bank and stuff like that. But you can do it with a lower credit score. Down payment isn't affected either way. You're looking at 3.5% of the purchase price in that type of financing. VA is the other common government loan that our team does. And with VA, there's no down payment, which is awesome. There's no PMI, no private mortgage insurance, because the VA insures the loan themselves, and that's terrific. And there used to be price caps on VA loans depending on the state and county. Now they've lifted those, so there is no price cap. So you can get a really, really nice home with VA. We've closed a couple the last 2 weeks in the $600,000 to $800,000 range with no down payment. With FHA, there are price caps depending on the county, and our market, you're in that $420,000 range, which will still get you a long way as far as a nice house in a great neighborhood. Again, it's got to be a residential property. That's 1 to 4 units, so a single family. You could also do a 3, 2, or 4 family, as long as you live in one of those units. So the big benefit to this kind of loan is credit requirements are less. Down payment is still low. Other ways to deal with the down payment issue, if the 3.5% sounds like that might be a challenge, is that there's down payment assistance programs that we work with and can connect you to, both community and state programs to assist in the down payment. You can get most or all of what you need with one of these kinds of programs. Again, the credit's got to be of a certain level, but we can work with you on that. As mentioned, seller concessions can cover closing costs. You can also get a gift from a relative for all of what you need for down payment and closing costs. We also have clients that actually have a relative purchase the property for them, and then work out the terms with them as the buyers once they're there. So for example, in that case, you might have an out-of-town relative who purchased the house for you. You move in and work out a land contract or a rent-to-own or something like that. But the benefit to the person buying that home is that it's looked at as investment property. So there's a whole slew of tax benefits and breaks and things like that as an owner of an investment property that they can take advantage of as well. So we do that quite often. Another very common place to find down payment funds is your 401k plan at work. A lot of folks don't know you can access that, but as long as it's for primary residence, you want to check with your HR department, but most places will allow you to use 401k for the down payment. Once we have the best possible real pre-approval set up, that's going to give you a lot of leverage in the marketplace. But depending on where you're looking, you still might need to add a little bit more flame to the fire there to get your offer accepted. So there's some strategies that we can work with you on. I've got a PDF I can send you that has, we call it our offer toolbox, that has 10 different ways that you can separate yourself from the pack there where you're trying to find or trying to negotiate a home when there's competition on it. We've seen first part of the year, we were in the toolbox just on about every transaction. Now, again, the market's kind of softened up a little bit. The time of year is such where it's not quite as competitive, but this spring, we'll have to see what happens. So even though rates are higher, I'm not noticing yet a big difference between the inventory and the number of buyers out there. It's still slanting in favor of the seller because even though there's fewer buyers, there's also fewer owners who are putting their houses on the market. So we'll just have to kind of see how that works. But number one is you can actually become a cash buyer. So if you remember back to my first transaction scenario where we were putting $100 bills in front of that seller, you can actually in Ohio, you can actually do that in our market. We've got a company that we work with who will put the cash up for you to write a cash offer on the home that you've picked out. And there's a fee involved with that. And there's basically kind of two ways that it works. The cash offer is made to the seller. And then you go ahead and go about your business and get your mortgage done the way you would normally do it. The house gets appraised, get pre-approved, we get cleared to close. And at that point in time, the cash is not needed because you've got your financing all lined up. So there's a smaller fee involved to that third party partner at that time because they were willing to purchase the cash or home for cash for you if they had to. That's the most common scenario with that program, is that the cash offer is made, but it's not needed at the end of the day. If it is needed, then the company will pay cash for the property. And at that point in time, again, all the numbers have already been worked out, so there's no risk there. But you've got 6 months to get the property closed. So for whatever reason, if you didn't close, there's time to work out whatever that reason was. If you're buying a flipped home and you're going FHA, and FHA has a flip rule where you can't transfer the title for a certain amount of time, that would be a situation where the cash offer would definitely be used, and the second closing with your financing would happen after the fact. We talked about the benefit of seller concessions and the benefits of those. Now, the downside is that seller concessions aren't free money. It's not a grant program or anything like that. It's coming out of the seller's pocket. So in a competitive situation, a lot of times it's better, even if you would like the seller to pay your closing cost, it's not a good idea to ask for it because it lowers their net that they're going to make on the home. And if you're in competition with three other buyers, let's say that don't need that help, then you put yourself in a tougher negotiating position because you're asking for it. An escalation clause is something else that we've done a lot over the last couple of years, where you can make an offer on the home, and you kind of feel like there's a good chance that that price is going to be uh, bumped up because of competition and all that, but you're not really sure by how much, and you're not really sure that you want to just go up and up and up and up. So what you can do is build in some elasticity to your offer, but still establishing some boundaries to the offer. So, for example, if the house is on the market for 200,000 and you would like to buy it for 200,000, but you're willing to go to 215, let's say, if you had to, but you don't necessarily want to give away $15,000 if you don't have to. So we make our offer for 200. We would specify in the paperwork that you'll go, say, $2,000 more than the best offer they have on the table, up to a price of 215. So you offer 200, somebody else offers 210, then your offer would escalate automatically to 212 and you get the house. You offer 200, somebody offers 220, then you're not obligated to go up to that range because you built in that cap at the 215. The other thing is what's called appraisal gap coverage, and that's where uh, we have buyers who kind of solve that a problem that sellers have when they do sell a home over the asking price, and that has to do with the appraisal. So, regardless of what the seller thinks the house is worth, regardless of what the buyer thinks the house is worth, if there's a loan involved, the bank is going to come in and they're going to have a huge say as to what that property is worth by doing an appraisal. And sometimes appraisals come in low, and they're more likely to come in low if that price has been escalated up way over the asking price. So again, we're not seeing a ton of that right now, but earlier in the year, it was very common to put a home on the market for 250, have it sell for 280, and then have the appraisal come in, let's say, at 275. So one of the tools in the box to combat that is up front, you would put in an appraisal gap commitment of, in this case, let's say up to $10,000. So because the property appraised 5,000 below the agreed sale price, normally the seller would have to decide if they wanted to lower the price 5,000 or not. With appraisal gap commitment, the buyer would be saying up front that, hey, if the house does come in lower, then we will take that risk, and we'll go ahead and pay that 5,000 ourselves. And the reason that you would do that, and the benefit to the buyer, is that that's something less that the seller has to worry about, because they don't want the house to underappraise, and now they got to put it back up on the market. You're curing that problem up front with the appraisal gap. And moving forward, we've been in this stronger market long enough where we're going to be seeing less and less than that, I think. But it is something, again, to have in the toolbox if you think you need it, and depending how badly you want the house when it comes on the market. So those are kind of the main negotiating tactics that we use in situations where we think there's going to be a lot of competition on the home. So all that kind of falls under the umbrella of step one, which there's a lot to it. I mean, step one is like climbing the mountain, getting ready to go. But once you're there, then it gets a lot more fun, I promise. And the second step now is we're going to start reviewing home information. Well, of course, everybody knows that all the listings from all the companies are on different websites, and you can jump on this site and that site and see what's up there. There is an actual uh, uh, real estate agent only version of that MLS information that only an agent can hook you up to. And that's the link directly into the MLS database, where again, all homes by all companies, but we can set it up where you have immediate notification when things actually hit the street, just like you were a real estate agent. So, it can be a new home if you're looking to build, a resale, and we simply set up your filters as far as area, price range. You'll get those matches in real time, uh, and it's the best way. It's the best way to look. Um, we also, just FYI, we work with private owners a lot. I think moving forward, we're going to see a lot more for sale by owners, let's say. And we can work with you on those as well. Most of the time, an owner is interested in working with an agent. They just don't want to pay a marketing fee or something like that, but they'll work with the agents because they don't really know oftentimes how to do the contracts, what disclosure forms are needed, all that kind of stuff. So they're happy to pay somebody to come in and do that to help them out. So once we get the searches set up and you're getting things online and you're seeing houses that you're interested in, now we want to tour those homes. So number one, in most real estate situations, you've got what's called a listing agent, and then you've got a buyer's agent, and it's just like it seems. The listing agent is kind of working with the seller. The buying agent is working with the buyer, and I think that's the best way to do it because you've got an agent that's representing you. However, sometimes there's a situation where you go to an open house, or maybe you're driving down the street and you see somebody put a sign in the yard for a house that you're interested in, and you go ahead and contact that listing agent directly. And there's nothing wrong with doing that, but that agent shifts into that's what's called a dual agency, meaning that legally, they can't show any favoritism of one party over the other, but having been there myself, it's tough to do if you're listing the house for your mom or something like that you're not going to be, kind of looking out for that person. So because it doesn't cost you any money to have somebody working with you, I think it's better to have your own agent that can go in there, and their job is just the opposite of what that seller's agent job is, and that is to look out for you, to get you the best price, to get you the best terms. So I kind of equate it to going to court um, and sharing an attorney with the person that you're having the dispute with. But nobody would do that. So I don't think it's a good idea to do it when you're negotiating price and repairs and things like that on a home either. Other thing you have to watch is in today's market, when you start clicking around on different websites, what happens is your information starts to get sold to other people. And one of the benefits, again, of making a commitment and working with a particular agent that can hook you up to the Board of Realtors site is you don't have all those marketing things going on. You're not going to get approached by agents on the phone, and you probably have had this happen. I just refinanced my house and was suddenly getting all these phone calls from lenders, and that's how they got my information, was that I had applied online with a company to figure out my options, and my information got sold. So you have to watch that. And also, as mentioned, calling owners directly on signs, whether it's the listing agent, whether it's the owner. If you're, again, working with somebody, it's best to have them do that on your behalf. The final step is that once you find a home that you're interested in, is now we're going to make the offer. And that's where we're going to sit down and really decide how we're going to approach the negotiation. Is it a home that's going to be competitive? Is it one that's been sitting on the market for a long time? That's going to have an effect. Did the price just get reduced, or has it been out there for a month and we think the price is about ready to get reduced? What kind of condition is the home in? And then we're going to look at number one, the area sales. We'll put together a report, either of the street or depending on your home loan program, try to match what parameters that bank appraiser is going to use in choosing homes that they look at to justify the price of the home that you're looking at. So we put together kind of an appraisal style report. If you're doing this on your own, you can jump on the auditor site and there's all the pricing information there. The one thing about the report that we do, though, we do as a bank appraiser would, even though it's not an appraisal, we've seen hundreds of them. We're going to adjust values based on square footage and amenities and stuff like that. So give you an idea of whether you're in the ballpark or not on the price that you want to offer, because sometimes homeowners build in money that they want to negotiate with, and they know they're going to have to come down, and they're planning on it. So you don't want to go in there and offer them what they're asking in that case. Other times they've reduced the price of the house because they understand it needs a roof or whatever, and so we're pricing it a little bit below what it should sell for. This report will help determine which is the case. And if it's already priced to sell, then you don't necessarily want to go in there and lowball the owner and then lose out on competition. There's the point being, there's no rule of thumb there. You just have to look at the data and decide what's the best way to go about making an offer price. So as mentioned, you can do this yourself. If you do want some help through this process, we just ask for a few things. Number one is that you're committed and willing to get a real pre-approval, either with somebody that we can refer you to the proper lender, because all lenders aren't the same. Not all lenders have the same niche market. Some banks, for example, have great conventional loan products, but they don't cater to people that maybe have had some credit issues. Other mortgage lenders really cater to that part of the market and have things for buyers in the way of assistance with enhancing your credit score and just different programs. There's no lender that's got everything. So it's our job to go find which ones have what programs and make recommendations to you. So once we do that, then you can get that pre-approval done. We rarely take on a new client who's not willing to do that, because it's just in their best benefit to do that. Secondly, if you do decide that you want to work together after we talk some more, we just ask for loyalty, in that we don't get paid unless we help you find something. So we're motivated to assist you as best we can, and then in return for that, we ask that you don't work with a bunch of different real estate agents. And as I mentioned before, there's a downside to that anyway, in the way of just getting pestered with phone calls and things like that. It's better to kind of choose a path and stay with it. The last thing is that when you have a good experience, is that you refer our team to other folks Most of our clientele comes from referrals, people that we've worked with. About 80% of it. The other 20 would come in from an ad or something like that. But we just ask that friends, family, coworkers, that you pass us along when it's been a good experience for you. If you don't believe a word I say about about our team and how good we are, you can go on our website in gregunthankteam.net. There on the bottom of the homepage, there's all different video testimonials that you can listen to of folks that we've helped over the years. So if you have any questions about anything I've spoken about, you can click this link that you see over here to put a call on my schedule. And you can put a 15-minute phone call at your convenience to match an opening that I have. And the benefit of doing that is that we don't play phone tag. I don't know if you can see on the screen there, but there were little messages coming in all throughout the presentation, and those are all client texts, client calls. So if I'm tied up with somebody or my team is tied up with somebody else or in an appointment, then you have to leave a message and we're calling you back and you're not available and et cetera, et cetera. So by putting a call on my schedule, you plan the time, I plan the time. We can chat about what you want to do and how best to do it. So go ahead and do that now. Look forward to chatting with you, answering any questions that you have. And above all, thanks for taking the time to watch this, and best wishes in your home search.